Have you ever had that feeling, that uncomfortable sensation that the market is watching you and doing exactly the opposite of what you want? Let me give you an example. You will recognize yourself in this. You spot a nice bullish trend. Higher highs, higher lows. Clean, clear. Then the market pulls back. It comes back gently to the last support level. And right there, on that support, it gives you a beautiful engulfing candle. A confirmation that looks solid, 80% reliable. You think to yourself, this is the signal I was waiting for. You enter at the close of the candle. You set your take profit nicely at the previous high. Everything is logical, textbook trading. And then, the market pretends to go up, just enough to give you hope. And suddenly, it turns around. It drops. It comes down to hit your stop loss. Gone. But it doesn't stop there. You look at your screen and you notice that the old support, the one you bought on, is now broken. It has become resistance. So you switch sides. You think, okay, the trend has changed. I'm going short. You open a sell position. And then, boom, the market reverses a second time. It blows through your second stop loss. Like magic. Except this time, you've had enough. 2 stops in a few minutes. You're done. You decide to just watch. Sit on your hands. Do nothing. And that's exactly when the market explodes to the upside. A massive candle. The direction you saw from the very beginning. Except this time, you're not on the train. You're standing on the platform, holding 2 stopped-out tickets. You feel like you're cursed, like you're a victim of some spell. You wonder if trading is just a giant scam. Don't worry. I'm here today to shed some light, to show you what's really happening behind those candles. And trust me, it's not magic. It's liquidity. In this video, we're going to take everything apart, piece by piece. Here is the program. 1. The raw material. What liquidity truly is, and how to spot it without any indicator. 2. The battlefield map. The 3 types of liquidity institutions are hunting: external, internal, and the nasty trap of the trendline. 3. The invisible trap. How $50 million enters the market without blowing it up. The game of fake confirmations and stop hunts. 4. The trapper's scalpel. The exact checklist to identify a valid sweep. And why anticipation is a death sentence. If you want to finally understand why your stop loss gets hit right before the real move, if you want to stop being the fuel and become the driver, then stick with me until the end. Grab a notebook. Let's start right now. What is liquidity really, and how to spot it? Now that you know what the trap looks like, it's time to understand why it works so well. And it all starts with one word: liquidity. Everyone talks about it. Very few truly understand it. So let's start from the beginning. No jargon, straight on the chart. Look at your screen. Imagine an obvious support zone, a level that price has touched 3 times and never broken. Every retail trader sees the same thing you do. They think, this support is solid. If price comes back here, I'm buying, and I'll place my stop loss just below it. They all place their stops in the same spot, just under that line. This cluster of stop orders, this accumulation of waiting money, that is liquidity. Now ask yourself this question. If you are an institution with $50 million to buy, where are you going to find sellers? You're not going to buy at market price and blow up the chart. No, you're going to go exactly where all the stops are parked. You're going to push price just below the support. Look at what just happened. Price breaks the support. All the stops get hit. Thousands of traders are liquidated. They're forced sell orders. That is exactly what the institution wanted. They absorb them. They buy while everyone else is panicking. And once everyone is out, price shoots back up, above the support, and continues the trend. You are on the sidelines. Your stop is gone, and you're watching the train leave without you. That is liquidity in action. Now, here is how to spot it before the trap closes. Number 1. Equal highs and equal lows. When price touches the exact same level twice without breaking it, all the stops are placed just above or just below. That tiny zone is a pool filled with orders. The market will come to empty it. Number 2. The Wicks of the past. See that long shadow? That candle that plunged down and immediately reversed? That's a memory. The traders who bought the tip of that wick have their stops below it. The traders who missed the move have pending orders waiting right there. The market loves to revisit these wicks. Number 3. The gaps. When price jumps too fast, it leaves a hole, an empty space. That gap is filled with pending orders. Price almost always comes back to fill it before making the real move. So, here is the phrase you need to remember. Burn it into your brain. Liquidity is where everyone places their stop loss. It is where price will go, just before making the real move, without you. Now that you know what liquidity is and where it hides, let's move on. Part 2. The 3 types of liquidity. The battlefield map. The 3 types of liquidity. Now that you know what liquidity is and where it hides, it's time to learn how to map the battlefield. Because not all liquidity zones are equal. They don't have the same function. They don't announce the same thing. In the ICT concept, we distinguish 3 types of liquidity. 3 types you absolutely must know how to recognize. Let's go. Type 1. External liquidity. This is the most obvious one, the most visible. External liquidity is located beyond the obvious boundaries of the market. Visually, these are the equal highs and equal lows. Look at this consolidation zone. Price has touched the exact same high twice. It failed to break above. All the traders who sold this double top, they placed their stop loss just above it. That tiny zone above the 2 highs is a pool of external liquidity. What is it used for? This liquidity is the market's favorite bait to end a trend or start a deep retracement. Classic scenario. Price is in an uptrend. It goes up, up, up. Then it forms a double top. Everyone thinks it's about to reverse. The market pretends to go for the breakout. It moves above the 2 highs. It triggers all the sellers' stops. And once all those stops are taken out, once the external liquidity has been collected, price has no more fuel. It collapses. The trend reverses. Remember this. External liquidity often announces the end of the current move. It's the temporary terminal. Type 2. Internal liquidity. This one is more subtle, but just as powerful. Internal liquidity is located inside the trend, in the small consolidations, in the pullbacks. Visually, these are the small swing lows in an uptrend, or the small swing highs in a downtrend. Look at this small low. It's not a major support, it's just a pullback. But all the traders who bought during this dip, they placed their stop loss just below this small low. That zone is a pool of internal liquidity. What is it used for? This liquidity is the springboard that allows the trend to catch its breath and resume. Classic scenario. Price is in an uptrend. It consolidates. It forms a small low. The market comes and breaks just below that low. The stops of the late buyers get hit. They get faked out. They think the trend is over. But that's exactly when the market takes off again. Stronger, faster, in the original direction. Remember this. Internal liquidity announces the end of the pause and the violent resumption of the trend. Type 3. Trendline liquidity. This one is nasty. It traps even experienced traders. For decades, everyone has been taught to draw trend lines, diagonals, and everyone places their stops just below these lines. The algorithm knows this. When price approaches this line, it doesn't just touch it gently and bounce. No, it pierces through it. It goes below by a few pips, just enough to trigger all the stops of the trend followers. Everyone thinks the structure is broken. Traders panic. They flip their positions. They sell. And it's precisely at this moment of maximum confusion that the market turns around and explodes in the original direction. Remember this. The sweep of a trend line is the final trap, right before the real acceleration. Let's summarize. 3 types of liquidity, 3 different functions. External liquidity, above equal highs, below equal lows. It announces the end of a trend or a major pullback. Internal liquidity, below a small bullish swing low, above a small bearish swing high. It announces the resumption of the trend. Trendline liquidity, a slight break of an obvious diagonal. It announces the end of the correction and acceleration. Now that you have the complete map, let's get to the heart of the matter. The invisible trap, how 50 million enters the market. Now we get to pure practice. You know what liquidity is. You know where it hides. You know the three types. But you're still missing one thing: the exact mechanism, the precise sequence of the manipulation. How does an institution enter $50 million into the market without blowing up the price? Let me show you, step by step, straight on the chart. Let's keep the bullish trend example. Price is rising. Higher highs, higher lows. Clean. Then it pulls back. It retraces. It comes back to an obvious support level, a level that has held multiple times. Everyone can see it. And that's where the show begins. Act 1. The false confirmation. The institution enters the scene. But they don't pull out the heavy artillery right away. They start with a small operation. A bait. They buy $500,000 worth. That's tiny for them, but enough to gently push price higher. Look at what appears on your screen. A beautiful confirmation candle. A bullish engulfing. Right on support. It's too perfect. You think to yourself, this is the signal I was waiting for. The confirmation is here. I'm buying. You enter long. You place your stop loss just below the support, right where everyone else places it. And you're not alone. Thousands of traders around the world are doing the exact same thing, at the same moment. You just signed the check. Act 2. The stop hunt. Now that the retail traders are in, the institution moves to step 2. They execute a second operation. This time, they sell. And they sell bigger. $1 million. This small sell order, it chokes the bullish momentum from Act 1. The market pretends to reverse. Watch what happens. Price drops. It heads straight for the support. Straight for the zone where you placed your stop loss. The support is broken. Your stop gets hit. The stops of thousands of other traders get hit too. You look at your screen. You're out. You lost. And then, you see that support is broken. You think, the trend has changed. This is a reversal. I'm going short. You open a sell position, like so many others. That's exactly what the institution wanted. Act 3. The absorption and liftoff. This is the decisive moment. The moment of truth. The support is broken. The buyer stops have been taken out. Thousands of traders are now sellers, thinking they're riding a reversal. This cascade of sell orders, this is the liquidity the institution was waiting for. The institution is there, silent, on the other side of the order book. They absorb everything. They buy, massively, against your panic sells. This is the sweep, the collection. And once the flow of selling is exhausted, once all the stops are digested, they hit the big button. The 50 million goes in. What happens on your screen? Price reclaims the zone violently. A long wick down, then an explosion to the upside. The direction? The original trend. The one they were respecting all along. Except you're not on the train anymore. You're on the platform, holding your stopped-out ticket. And maybe even a second one if you flipped short. Let's summarize the sequence. Remember the example from the beginning of the video? The one where you got faked out twice? Now you understand what happened. 1. False confirmation, to get you in. 2. Break of support, to get you out. 3. Explosive reclamation, to start the real move without you. It's a 3-act trap, and it repeats every single day, on every market. Now, the only question that matters, how do you stop being the victim? That's part 4, the trapper's scalpel. How to identify a valid sweep and enter at the right time. Here is the part everyone has been waiting for. You know why price makes these violent back and forth moves. You know where liquidity hides. You know the 3-act mechanism. Now, the only question that matters. How do you stop being the victim? How do you enter after the trap and not before? That's what I'm going to show you now. The method is simple. It requires no magic indicator, just observation and discipline. Here is the exact checklist, step by step. Step 1. Identify the ambush zone. First thing, and this is non-negotiable, you must spot the liquidity pool, the place where everyone has placed their stop loss. This is where the crime will happen, just below the obvious support, just above the obvious resistance. You do not enter before price visits this zone. You sit on your hands. You wait. You are the sniper, not the infantry running around. Step 2. Observe the break and the wick. Price finally arrives at your zone. There is a moment of hesitation, and then, bam! Price breaks the zone with shocking speed. This is the moment of panic for others. For you, it's the signal that the show has started. But pay attention, the break means nothing without what comes next. What comes next is the reclamation. You must see price come back inside the zone it just broke. Price was above support, it goes below, then it comes back above. And here is the crucial detail that validates the trap. This reclamation must happen before the candle even closes. That is the real confirmation. Step 3. Verify the candle anatomy. Now look at the shape of this candle. The vast majority of the time, you will see what's called a hammer or a pin bar. You know the one, a small body with a very long wick sticking out. Picture what just happened. 1. Price plunges below support. That long wick down is the execution of stops, the collection. 2. Price immediately reverses and closes the candle above the support. Once that candle closes, the message is clear. The institutions have finished filling their bags. The stops are gone. The light turns green. Step 4. Beware of the flash sweep. Now, there is one small nuance you need to know. Sometimes, the market is so greedy, the manipulation is so brutal, that price doesn't even give you time to admire the wick. It breaks, it reclaims, and it explodes higher before the candle even closes. You see the long wick forming in real time, but the body of the candle is already miles away from the zone. In this case, you don't wait for the close. The violence of the move is the confirmation. It's a sweep in fast forward. The signal is the same, it's just faster. The golden rule. And here, I need to emphasize a point that might just save your account. I am radically against anticipation. So many beginners see price approaching the zone and think, let me get in early, better entry price. Fatal mistake. Why? Because the sweep can go much deeper than you think. It can liquidate you before reversing. You placed your stop 10 pips below the support? The institution has zero problem going 11 pips down, just to grab your $10, and the $10 of 10,000 other traders just like you. We do not trade the sweep in anticipation. We trade the reaction to the sweep. Wait for the zone to be broken. Wait for the reclamation. Wait for the candle to close. Unless it's a flash sweep. Only then do you press the button. Confirmation is the proof that the trap worked. Without that proof, you stay out. This is the discipline of the hunter, and it's the only way to survive and thrive in this jungle. Final summary. You now hold all the cards. You know what liquidity is. You know where it hides. You know the manipulation mechanism, and you have the checklist to enter after the trap. The sequence to remember. 1. Spot the liquidity zone. 2. Wait for the break and the reclamation. 3. Confirm with the hammer candle. 4. Enter only after confirmation, never before. The market will not change. Institutions will continue to hunt stops. You now know what's hiding behind every candle, behind every fake signal, behind every stop loss that gets hit right before the real move. It's not bad luck. It's not a scam. It's liquidity. Institutions are not cheating, they're just playing with rules that everyone ignores. Now, you know those rules. You know how to spot liquidity zones. You know the 3 types: external, internal, trendline. You know the 3-act mechanism: false confirmation, stop hunt, explosive reclamation. And most importantly, you have the checklist to enter after the trap. Never before. If this video opened your eyes, if you finally understood why your stop loss always got hit at the worst possible moment, then do me a favor, drop a like. It helps the algorithm and tells everyone we're here for real education, not for $1,000 courses. Subscribe if you haven't already. We're going to keep debunking trading myths, together. And tell me in the comments, have you ever lived this scenario? That feeling of being trapped right before the massive move? Share your experience. I read everything. The market will not change. The traps will continue. But now, you know. You are no longer the fuel. You are the driver. See you in the next video. Take care, and trade with your eyes open.